For years, everyone has blamed the next financial crisis on the same things: AI bubbles, China, inflation, politics, whoever happens to be sitting in the White House. But one of the biggest threats to the global economy is something way less exciting. Most people have never even heard of it. And weirdly enough, it starts in Japan. Because if you've been wondering why mortgage rates still feel painfully high, why markets panic every few months, or why the Federal Reserve talks about cutting rates, but money still feels expensive anyway, the answer might not actually begin in Washington. It begins in Tokyo, more specifically, inside the Japanese bond market. And honestly, this story sounds boring at first, until you realize the entire global financial system quietly got addicted to cheap Japanese money. To understand why that matters, you have to go back to the early 1990s. Japan had one of the biggest financial bubbles in modern history. Real estate prices exploded, stocks went insane, and then everything collapsed. Property values crashed, the stock market got destroyed, economic growth flatlined. What followed became known as Japan's lost decades. For years, the country struggled with weak growth, low inflation, and an economy that just stopped moving. So the Bank of Japan tried to revive things the same way central banks usually do during a crisis. They cut interest rates, first to near zero, then eventually below zero. But even that wasn't enough. So Japan went even further and introduced something called yield curve control. Basically a policy where the central bank stepped in to keep long-term interest rates extremely low, whether markets liked it or not. In simple terms, Japan made borrowing money unbelievably cheap, and that changed global finance forever. Because now imagine you're a Japanese pension fund, bank, or insurance company. You're managing billions of dollars, but your own government bonds pay almost nothing. So you have two choices. Keep your money in Japan and accept terrible returns, or move your money overseas where yields are much higher. Japan chose overseas. Over time, Japanese investors became some of the biggest buyers of US Treasury bonds, mortgage-backed securities, foreign stocks, and global assets of every kind. Eventually, Japan became the world's largest creditor nation, meaning it was constantly lending money to the rest of the world. And that's where this story starts affecting everyone else. Investors realized they could borrow money cheaply in Japan, convert it into dollars, and invest in higher-yielding assets somewhere else. This became known as the yen carry trade, and the strategy was almost stupidly simple. Borrow yen at extremely low interest rates, convert it into US dollars, then buy assets paying higher returns, like US Treasury bonds yielding 4% or more. After costs and currency hedging, investors kept the difference as profit. Easy money. And once investors realized how profitable this was, they didn't stop at bonds. They bought tech stocks, real estate, emerging markets, private equity, basically anything with higher returns. For years, cheap Japanese money quietly became fuel for global markets. Some estimates put the yen carry trade in the trillions of dollars. And the entire system depended on one massive assumption: Japanese interest rates would stay near zero forever. But then things started changing. After years of ultra-loose policy, the Bank of Japan finally began raising interest rates and slowly stepping away from the policies that kept borrowing costs artificially low. Suddenly, the math behind the carry trade didn't look so attractive anymore. Borrowing in yen became more expensive. Currency hedging costs rose too. And investors started realizing the era of free money might actually be ending. Markets didn't ignore the shift for long. Japanese stocks saw sharp volatility. US markets reacted too. Bond yields climbed because investors understood something important. One of the world's biggest sources of liquidity was starting to disappear. And when that happens, money doesn't keep flowing out of Japan. It starts flowing back in. That process is called repatriation. Now here's why this matters so much for the United States. For decades, Japanese investors were some of the most reliable buyers of US government debt. And most people misunderstand how this works. The Federal Reserve mainly controls short-term interest rates, but long-term rates, especially the 10-year Treasury yield, depend heavily on supply and demand. So if a giant buyer like Japan starts pulling back, the US may have to offer higher yields to attract new investors. And that affects almost everything. Mortgage rates stay higher. Corporate borrowing becomes more expensive. Businesses slow down expansion. Investors take fewer risks. And expensive growth stocks suddenly become harder to justify. That's why this isn't just some boring bond market story. It's really a story about the price of money itself. For nearly 30 years, the United States benefited from massive amounts of foreign capital flowing into its financial system, especially from Japan. Now some of that flow is starting to reverse. And that creates a huge problem, because America is running enormous deficits and issuing massive amounts of debt every single year. That debt always needs buyers. For a long time, Japan helped absorb a huge portion of it. But if Japanese investors become less interested in foreign bonds, pressure on long-term yields could keep building. And that may be part of the reason markets feel so unstable right now. People focus on AI stocks, inflation headlines, or the latest Federal Reserve meeting because those stories are loud. This story is quieter, but underneath the surface, the global bond market may be going through one of the biggest structural shifts in decades. Because liquidity is like oxygen for financial markets. And when the flow of cheap money starts slowing down, everything changes. Stocks become harder to justify. Credit tightens. Risk appetite falls. Growth slows. The real risks usually aren't the loudest ones. Sometimes they're the boring systems quietly holding everything together in the background, until they finally start to crack.